Hey everybody, it's Rich from richonmoney.com. Most people grossly overestimate how much they're actually going to make on a rental property. Today we're going to talk about cash flow, return on investments. Thirdly, we'll discuss capitalization rates, and you'll know the difference between all three of those. I'll quickly go over the 1% rule and 50% rule so this will all make sense to everybody. Let's do it. First, let's discuss the biggest mistake that I see in real estate, and that is overestimating what you're going to make on a rental property. Friends brag to each other about how much they're making, and they're way off. Hey man, I started renting out my property for $1,000 a month. I got a $900 mortgage. That means I'm cash flowing $100 a month. Awesome. But wait a second, that doesn't make any sense. What about all the other expenses? What expenses? You say what your rent is, you subtract your mortgage, and you think that's your cash flow. And it sure as hell ain't. This is what we're talking about first today, cash flow. The definition of cash flow is pretty self-explanatory. It's the leftover amount of money after you pay all your expenses. The formula for cash flow is rental income minus expenses minus your mortgage. And in a lot of cases, there ain't much left. If your rent's $1,000 a month and you have a mortgage of $900 a month, there's only $100 left over, but you haven't even taken expenses out yet. I'm going to quickly go over two key rules you need to accurately do these estimates. That's the 1% rule and then the 50% rule. Let's start with the 1% rule. If a property costs $100,000, it should rent for 1% of that amount. On a $100,000 property, 1% of that, this property needs to rent for $1,000 or more to pass the 1% rule. Let's move on. The 50% rule. If your house rents for $1,000, you will spend approximately 50% of that on expenses. That's more than most of you realize. $500 a month goes to expenses. So let's do this math again that we saw earlier. $1,000 in rental income minus $500 in expenses minus a $900 mortgage payment. Ouch. That comes out to negative $400 a month. That's no way to do business. If you're going to manage yourself, maybe you can use 40%. In this particular case, under the 40% rule, ouch, you'd still be losing $300 a month. That's how you calculate cash flow. Now I'm going to say something about the 50% rule. When you do this for real and you want to know how much money you're actually making, you need to put in accurate numbers for all your expenses. Here's a list of many of the common expenses that come with rental properties. You need to go in and actually find the real numbers for these or get an accurate estimate. So that's cash flow. What about ROI, or return on investment, that we hear everybody talking about all the time? There's some subtle differences between the two. A return on investment has a simple formula. It's the profit on any investment divided by the cost of that investment. And this is by no means limited to just real estate. You can do this with stocks, price of tulips in Sweden. You can do this with anything. But we're talking about real estate today, so let's do this with a $50,000 house. It rents for $900 a month, its expenses are $300 a month, and there's a mortgage of $300 a month. Let's figure out what the ROI is. How do we calculate our profit on an investment? Well, that's easy. It's the cash flow. We did that above, which means we're going to take the rent minus the expenses minus the mortgage, and that's our profit. The rent is $900, the expenses is $300, and the mortgage is $300, giving us, drum roll please, a $300 cash flow or profit. Multiply that by 12 months and you've got $3,600 of cash flow per year. The formula for return on investment, or ROI, is profit divided by cost of the investment. $3,600 profit divided by $50,000 to buy the house. That gives you a 7.2% return on investment. Now here's the trick. That 7.2% is a pretty accurate number. A lot of times people are going to give you an ROI, or return on investment, on a rental property, but they didn't take out expenses, they're not figuring in a mortgage, or they're seriously fudging the numbers on those expenses. You've got to go in and check it yourself. And that's how you keep from buying a crappy property. So we've talked about cash flow, we've talked about ROI. What's the difference between these and cap rate? Well, it's actually pretty simple. When we're talking about multifamily properties and expensive commercial properties, people talk cap rates all the time. I bought this at a 7 cap. I bought this at a 10 cap. That's people using this term cap rate. The formula for cap rate is simple. Net operating income divided by current market value. And what is a net operating income? Well, it is all the money you take in every month, which you could call gross operating income, minus all your operating expenses. To help you visualize how a cap rate works, let's say a property costs $100,000, and then someone tells you this property is a 10 cap. That essentially means this property gives off 10% of $100,000 as net operating income every year. Here's what we've covered so far. 1% rule, 50% rule, cash flow, return on investment or ROI, capitalization rates, cap rate or cap. I hope this was helpful today. If it was, smash that subscribe button for me. Come on, help me out. And leave me a comment. What do you think the most difficult expense is to estimate? This is Rich on Money, signing off.